This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
It's my pleasure to welcome back a returning guest, and that is Jim Puplava. He is founder, president, and CEO of Financial Sense Wealth Advisors, and he also has his podcast where I came to know him many, many years ago, Financial Sense Newshour. Jim, welcome back. How are you?
Hey, great, Jason. Great to be back with you. Hope you're safe and you're not going crazy staying inside.
You know, I hate to say it because I know some people are having a really tough time with this, but I kind of like it. I've been enjoying this break from travel, and I used to live in Scottsdale, where I believe you are, right? Are you in Scottsdale?
No, that's where I grew up. I grew up in Scottsdale and moved to San Diego.
Ah, got it. And I lived there for a short time, too. I'm from L.A. and Orange County most of my life. But now I'm in Florida, and the weather is absolutely stunning. So this is not too bad for me. But I know it's hard on some people, so I don't want to minimize that or take away from that. And, you know, let's hope this all lifts soon and we get back to the new normal. I don't think we're getting back to normal, but we're going to have a new normal. And, Jim, I'm going to start off with a big macro question. What's the long-term play here?
You know, I think what we're going to go through, Jason, is a major whiff of deflation here. I mean, the supply chain has been disrupted, and that's going to take a while to correct. I think in the longer term, it'll be better because we'll need to bring some of that manufacturing. I don't care if it's vaccines to drugs back here. And very bullish on Mexico because I think that's where a lot of manufacturing is going to be going. But in the short term, when you don't have supply and you have great demand, how are you going to get that? And you're shutting down businesses, you're shutting down demand. So usually when you see something like this happen, which is a shock to the system, the first wave is deflation. But
haven't we already had that? We're in the deflation now. Look at oil prices, for example, right?
Yeah, but I mean, in the short term, I still think that we're going to be in a deflationary environment. Mm-hmm. And it's only when things get back to, I guess, if you can call it the new normal, when demand starts to pick up. I mean, you know, I live in California, and this is the first time I've been able to go anywhere on the freeways without a traffic jam.
Yeah, it's kind of pleasant in some ways, you know?
Yeah, I mean, you don't have traffic jams. You've got airplanes parked at airports. They're not in the air. And so eventually when we start to return to whatever that normal is going to be like, and people start filling their tanks, demand starts to go up, and all of a sudden you go from a base where oil prices are 11 and 12, and let's say a year from now they're over 30, that's going to start working its way into the economy. And then also there's going to be goods that are going to be in shortage, and you're going to have to pay more for them.
Right.
And so eventually, and especially if the government keeps injecting money like they're doing, then, you know, what's the definition of inflation? It's a lot more money chasing fewer goods and services.
And when you have the demand destruction that we've had, that is deflationary. Then you have a supply-demand shock after that, because after the demand's destroyed, the companies go out of business. Already the supply chain has been massively interrupted. Then when demand comes back, it causes inflation because now you have supply shock. There's no supply, right?
Yeah, let me give you a good example. Since we've been quarantined, of course, all gyms have been shut down because they're petri dishes for infection. Try to go to a health place, try to order a pair of dumbbells, exercise bands, home gym machines. They're sold out.
Yeah, and so the prices have gone up.
Yep, they're raising the prices. Why not? If you can sell everything you can get out the door, and then you got to remember, you got to make new stuff, and then the new stuff is harder to get. So you have a shortage of materials, you have a shortage of labor because a lot of people can't get to the factory. If you bring them back, you have to pay them more. Just take a look at what Amazon and Walmart are doing. All of that's going to be reflected in the cost of goods you're going to be buying. And now we're running into a food situation where you have places like Tyson are shutting down their meat packing plants, and so that's going to drive up the cost of food.
Yeah, it's really something. And I'll tell you, I would pay a lot of money for a haircut right now and to get my dog a bath because everything's closed, and charge me quadruple what you usually charge. I don't care. I pay it for both of those things. So yeah, it is really something. It is. But let's dive into this a little further. I mean, we have put the economy in hibernation mode. It is absolutely astonishing what has happened in maybe the world's first self-induced recession, maybe depression. I don't know. You can chime in on that. But what is that going to mean more broadly? Let's just unpack this a little more.
Well, let's put it this way. The longer they keep this in quarantine, as some governors are doing, although that may be challenged by the Justice Department, the longer they keep this going, they're going to turn a recession into a depression. And this reminds me of the early 30s, where we took what should have been a recession, turned it into a depression, then turned it into a Great Depression. The strength of this economy is a lot of small businesses account for most of the job growth. Well, those small businesses, when they did the NFIB survey, most businesses, over 50% of them said, we can't last more than 2 months. And then when they did the stimulus for the payroll protection plan, 4% of the companies, Jason, got 80% of the money. And so that's why they had to do stimulus 2 and replenish the stimulus fund or the PPP plan by another close to $350 billion. So you start putting small businesses out of business. I don't care if it's restaurants, small hotels, the local barber shop, local service companies, then all of a sudden you are creating higher unemployment. I looked at figures, who knows what it'll be this Thursday. We're doing this interview on a Tuesday, but we have 26 million people unemployed right now, filing for unemployment claims. And that's in 5 weeks. And think about it, Jason, 5 weeks ago or 6 weeks ago, we were at 3.5% unemployment. Now we're going to be in double-digit unemployment. So the longer they keep this going, the worse that this can be, which is why I'm really afraid that they could be making a major policy mistake here.
Yeah, that's quite a big deal, no question about it. So, I mean, look at like supply-demand shock in terms of restaurants, right? The demand collapsed, and then a significant portion of the supply will collapse because these restaurants are just going to go away. And then when they do reopen, as some are starting to, like in Georgia and so forth, the new rules will only allow them to operate at a small percentage of their prior capacity. So can you imagine the price of going out to dinner is probably going to skyrocket? Because the remaining restaurants that will still be there, everything will be spaced so far apart. All these new protocols will be burdensome on the restaurants and so forth, and it just won't work.
No, because you take an average restaurant. Let's take Friday and Saturday night. Most people go out for dinner. You want to fill that whole restaurant, and you want to turn those tables over 2 or 3 times because that's where you're going to make your money. Well, what are you going to do now on a Friday night when you can only fill your capacity by 25%? It's just economically, how are you going to pay for the chefs in the kitchen, the food supplies, the waiters, the busboys, the people that have to come in and clean when you're only operating at 25% capacity?
Mm-hmm. Yeah, it's something. I mean, going out to dinner is going to be a big, huge luxury in the near future, I believe, because they're going to have to sell those tables for a lot more money than they've been selling them, right?
Yeah, and it's like manufacturing. Any manufacturing plant, I don't care if it's GM or Ford or 3M, they have fixed costs. The fixed costs of the factory, the personnel, the management team, the workers, those are fixed. Then you have the variable costs, which are based on the amount of units that you're going to make. Well, that fixed cost, you need to have enough sales to cover your fixed cost, and then it's the additional sales where your profit margins come from. Well, think of a restaurant or any kind of business where you don't have enough in sales because of capacity to cover your fixed cost, you're going to be losing money.
So what do we do? What does this mean? I mean, I think we all get the problem. What does this mean to the broader market, and what other types of businesses are affected, and there's such a knock-on effect to all of this in so many ways, right?
Well, there's going to be a number of things, and thank goodness for the American economy. If it's allowed to operate, I think you're going to see some technological changes that are going to get around this. Let me give you a good example. We've got Amazon, which is the retail behemoth. And Amazon was overtaking companies in terms of market cap like Walmart, Target, Costco. What did all three of those develop? A major online presence. So in order to compete now, Walmart will have delivery. You can deliver, you can pick up stuff at the store. So this is going to create a lot of innovation. I've seen interviews of major restaurateurs who are saying, you know what, we're going to develop a takeout business. It's going to be a major part of our business. Ruth Chris Restaurants now has a takeout business. So businesses are going to adapt to that. Some that won't or don't innovate will fail. Mm-hmm. And it's going to be creative destruction. Yep. We're going to have to adapt.
Jim, that's why I like your show. I say the same things, and I haven't been listening to your show lately, I must admit, but Joseph Schumpeter, one of my favorite economists, the creative destruction is happening much more quickly, and that's one of the great things that is coming out of this. My veterinarian the other day sent me an email saying, now we can see your dog via telemedicine. My doctor sent me the next day, the following day, telemedicine app. Download it so you can see your doctor over your iPhone. I mean, I've been asking for this stuff for years. The technology is not new. They could have done it years ago, but they had no impetus. They had no motivation, and this has forced them to do it. So that's great.
Yeah, so you're going to see that. In fact, you speak of a pet. I took my dog out, and he got bit. I don't know if it was a scorpion, black widow, or brown recluse, and we just did it by video, showed the paw, the swelling, and the doc says, bring them in. That we didn't know if it was a snake bite or an insect bite, but apparently it was serious enough to bring them in.
Here's the thing that happens, though. These businesses, those efficiencies stay with that business even after the pandemic ends. And now those businesses are much more efficient all of a sudden. And that goes to productivity, because now that veterinarian and that doctor can make more money because they can see more patients. And the consumer or the patient benefits because they have better access to that doctor now too. Rather than waiting 2 weeks for an appointment, the doctor can be working at home and can do telemedicine appointments. The cost of all that real estate and staff that they used to have, a lot of it goes away. And so these are good efficiencies that are developing in the system. And I think they eventually create more prosperity. Yes, there is a change over time. Yes, people lose jobs. Yes, there's creative destruction. We all know that. But ultimately, it's better. Don't you agree?
Oh, absolutely. I mean, we have an office building, and last year, this might have been prescient by accident, but we took our cubicle space and turned it all into individual offices. So when we do go back to work, you could be self-quarantined by just being in your own office rather than a bullpen area where you're more susceptible. And the other thing is we're adding more brokers, and they can have their own office and operate remotely. So I don't need any more brick and mortar space. So it's more efficient.
It is more efficient, but commercial landlords hate it. Carl Icahn is shorting commercial real estate, and that is bad news for commercial real estate, and the retail apocalypse is only going to get worse, sadly. It's pretty crazy what's going on out there. So, Jim, talk to us about oil and the other commodities, if you will, for a moment. It's absolutely astonishing what has happened in the oil market.
Well, I mean, it was the perfect storm. You had demand destruction coming in from the COVID-19. So, I saw a picture of a major airport. I'm trying to think if it was Dallas or it was Chicago, where the planes were parked on the runway like a parking lot. So there's 75% of the planes that aren't in the air. And if we're all quarantined in our homes, you're not driving to work. So you had demand destruction. At the same time, you had this price war between the Saudis and the Russians flooding the markets with oil. And then on top of that, you had other things that were going on in the global economy. So you've got a glut of oil. There's like 750 super tankers in the globe, and 85 of them are now being used for storage. You've got Cushing, which has about 10 million barrels of oil storage left. They project by the middle of May, Cushing will be completely full. So you had all of that occurring at the same time. Then you have the problem between the paper market, which is futures, and the physical market, which is oil companies, refineries buying oil. And you had an ETF. This is something I talked about 3 years ago with this index bubble. And you had this fund called USO. They owned 25% of the May contract. Well, USO typically rolls over its contracts every single month. In a normal market, Jason, you're able to roll that over. But USO is not in the business of taking delivery. Well, what happens is they got to a point there was no place to roll that over, and they couldn't take delivery, so they ended up selling their oil, paying people close to $40 a barrel to take it. So we had a 300% drop in oil. Now what you have going is they have roughly about 40% of the June contract and over 40% of the July contract. So you could run into the same problem, but this time Cushing could be empty. Now, or not empty, but completely full, because they were at 85% capacity heading into May, and with May, they could be at full capacity. So the only alternative would be for the president to open up the strategic oil preserve and allow that for storage.
The opposite of the problem they created it for, right?
Yeah, I know. Isn't that funny?
Yeah. They created it to let the oil out in case we were cut off, right? Yeah, in case we had a disruption. So this is the exact opposite. Fascinating.
Yeah, so this is going to be with us, and it's not going to be until we are somewhat normal. Now, here's the real key thing, in my opinion, whether we go into a recession and come out with a U-shaped recovery or we go into a depression. And that would be what happens in the fall, because we know right now we don't have a vaccine, and I think we're better able to handle if it comes back. We know more about protocol, social distancing, but if we start shutting things down when the next flu season starts in October and we do the same thing, we're in a depression.
Well, there's no academic definition for depression, right? But what do you consider? 4 quarters of a flat or declining GDP? Is that what you're calling it?
I would say more than a year, and then you're looking at unemployment rates that are in the high double digits.
Yeah.
And they're talking right now 13 to 15% to 16% by June. And then you've got Bullard and Janet Yellen talking about 30%. So a lot of that is all dependent on what happens this fall if we get a second wave and if the second wave is deadlier. So a lot of this is, and here's the thing that this is where I want to be on the positive side. When you look at the Oxford study coming out, there was going to be 2 million deaths. Every single one of these COVID-19 models has been far off the mark. A good example is New York. Cuomo wanted 40,000 respirators. They only used 5,000. So
yeah, you can definitely short ventilators. They're going to be in massive oversupply. It's going to be like oil with those things soon. They're going to pay you to take them. Yeah.
So it's a lot of this is a big if right now, but I'm a little bit more optimistic that we're better prepared for it. A lot of these things, and also taking a look at a lot of the death rates. A lot of those death rates, Jason, were associated with comorbidities. Right. So people that had heart disease, autoimmune disease, other respiratory COPD are associated with those deaths.
Sure. So, and so it's not really necessarily a COVID death, and the world may never know, as to the miscategorization. But I have not heard or seen this anywhere. It's just my own thing. But the federal government came out a few weeks ago and said, "Don't worry, we'll pay for COVID treatment for anybody." Regardless of Obamacare, nationwide insurance, whatever. Just no matter what, we'll just cover it. Okay. And you might remember when they said that. Well, why wouldn't they categorize everything as COVID-19? Because the hospital wants to make sure they're paid and they know the government's going to pay them. So that seems like an obvious reason to miscategorize a lot of this treatment, right?
Well, yeah, there were two doctors that worked in ER that put out a video that said that a lot of their peers are getting pressure from the hospital to add COVID to their autopsy report. And a lot of it is for that reason.
Yeah.
If it's COVID, they get paid.
Yeah, it's crazy. This is ridiculous. Every time the government and the central bank gets involved, you get all these distortions and all this false reporting and all this abuse and corruption. It's just too bad. It really is. Hey, let's talk about fiscal policy for a moment, okay? So we talked about the supply-demand shock, how it initially creates deflation, then it creates inflation. And, we're obviously in the deflationary cycle right now. But, what do you think about the fiscal policy of all of this money creation? I mean, are we going to have an inflationary future, or as I think, a stagflationary future?
I think you're going to see stagflation. And one of the reasons is, as we just previously talked about, if you are killing supply, killing small companies, killing suppliers, then all of a sudden you start coming in with big fiscal spending. We got, as I wrote in my article, The End of Money, fiscal or stimulus one was just the first of many to follow. So we just got a supplemental fiscal stimulus. That's $500 billion. They're working on another fiscal stimulus that's supposed to be by the end of May or June, which would include suspending payroll taxes for employees, employers, and maybe a possible monthly check of $2,000. So that's going to put demand. Okay, that's great, but what about supply? And the other thing that they're going to do is, I'm trying to figure this out, and we're trying to project, because the budget deficit was going to be $1 trillion heading into the government's fiscal year ending this September. That was before the 2.1 or 2.2 trillion. You just added another $500 billion. Then they're talking about stimulus 3, which is going to be $500 billion. But Jason, that's only part of the story. The other part of the story is, when you have 26 million people unemployed, and maybe it goes over 30, or who knows what that number is going to end up being, that means those are people that aren't working, which means that they are receiving unemployment benefits, so social spending goes up. That's number one. Number two, they're not paying taxes, so tax revenues go down. So in addition to this additional spending that is coming from this fiscal stimulus, you also have the major drop-off in tax revenues. At the same time, the increase in social spending. So we could be, within the next 2 years, we could be at $30 trillion in national debt.
So
and that's why I think eventually they're going to devalue the currency.
Yeah. So the gold bugs would say, Peter Schiff would be out there to buy gold. He's been saying that forever, but Peter Schiff has got a checkered record here. His arguments are good. I like the arguments, but the result never seems to pan out the way he says it. So currency devalues. But the question we've got to ask ourselves, Jim, is compared to what? I mean, a lot of central banks are pumping stimulus into the system. So the dollar index is only a comparison, right?
Here's the issue I see. Everybody's devaluing their currency and they're pumping out money, but the Fed is like on steroids. I mean, we added $1 trillion to the Fed's balance sheet in 2 weeks. We're doing daily what they used to do monthly. And, I've never seen anything like this. And then we're also seeing the Fed move into areas they've never done before. Before it was, in the last crisis, it was treasuries and junk mortgages. Now they're moving into the corporate bond market, buying triple Bs, ETFs. They're moving into the junk bond market. They're going into there. They're going into municipal bond market. So there is going to just be no end to this in terms of what they're doing. And eventually what I think they're going to go to is they're going to try to flatten the yield curve. And there's a great anybody that subscribes to the Wall Street Journal, I've got a Bloomberg, so it looks different. But if you go to the Wall Street Journal, go to the markets page, and then scroll down and go to bonds, and they have a yield curve where it was a year ago. A year ago, you were looking at 30-year bonds or 10-year bonds at 3%. Today, 30-year bonds are a little over 1%. So they're trying to keep the yield curve steepened, but flatten it, which they've done. I mean, you're talking about almost 200 basis points drop in yield on a 30-year bond. And eventually, Jason, I think they're going to do two things. We've got ZIRP, which is zero interest rate policy. The second thing they're going to go is to NIRP, which is negative interest rate policy. And as crazy as that may sound, several weeks ago, if you went into 3- and 6-month T-bills, they were negative.
Do we have to look at money itself like oil and like self-storing your extra furniture, where you literally have to pay for storage? I mean, it's a strange world, you know?
Hey, I'm kidding. You know what else they're thinking of doing to it? And there's a Fed paper, I'm going to put this in my next article, where if you look at your dollar bill, like your $100 bills, and you see that little metal strip in it, there is going to be a tax on cash. And they'll come up with some cockamamie idea, well, hey, people are doing this, you know, with the drug trade or some kind of illegal thing, terrorists are using it or something, but they're going to penalize you for cash, because what the government does not want is a deflationary environment where the asset markets collapse, because then debt becomes toxic. So how do you inflate the debt markets? Is you get people out of cash. Now, here's something that's going to scare the hell out of you. We have a little over 14 trillion in cash in the banks. These are, you know, that's what people have in their checking account, savings account, money market funds. We only have a little over 1 trillion in actual bills to pay that. So if everybody wanted to pull their money out at the same time, there's only about 1 trillion to back 14. Then if you look at
1 trillion
FDIC,
backing 14 trillion. Okay.
Yeah.
Yep.
Yeah, and it gets worse. Then you look at FDIC. There's only about $100 billion in the FDIC fund to back 14 trillion in deposits. So this is an event the Fed can't afford to happen. This happened in the early 30s when the dollar was backed by gold. People used gold as money, and people start going to banks and demanding gold.
Right.
Well, all of a sudden that starts sinking the banks. The banks start going under. And what did Roosevelt do? He declared a bank holiday.
Yeah.
Yeah, confiscated people's gold,
right.
And then we came up with the FDIC.
Yeah.
And I think we're at some point, if we keep going down this direction, that's going to be the end game.
You know, I'm curious, Jim. I have a feeling I know where you'd stand on this, but I've never actually heard you say it, so I'll ask you. What do you think about digital cryptocurrencies, Bitcoin, et cetera?
I'm not a big fan of it because it doesn't have a lot of the characteristics of money. Yeah. And the best example I can give you is Bitcoin going from 1,000 to 18,000 down to 4,000 again.
Right.
Yeah. So can you imagine if you were a car dealer and Bitcoin's at 18,000 and you're going in and buying a Lexus, a Toyota, maybe a Honda, you pay for it in 2 Bitcoins when it's at 18,000, and a month later it's down to 4,000. What happened to that dealership?
Right. It's a disaster. It's like a Zimbabwe-esque disaster one way, you know, depending on which direction it's going. But the other problem with all of the cryptocurrencies, of the bunch, Bitcoin is the best, I believe. But I don't believe in any of them. I'd like to be wrong about it. But the cryptocurrency that's going to win the day is the one backed by the Fed and the U.S. government. And they're going to have one. And then when they have a digital currency, we are going to lose our spending privacy. Of course, there will be a reason, just like you said. It'll be, well, terrorists and drug smugglers and stuff are using, you know, we need to eliminate cash, and also the virus spreads on cash bills. So it's time for a digital currency, a digital dollar. And I think that's where it's going.
Oh, I agree with you 100% because they want to get rid of cash.
Right.
And then also they can monitor you, and also just think of the power the government has to turn off access to your cash.
I know. It's no longer a thing if they think you've committed a crime, this civil forfeiture, and, they could just go take your stuff. That's bad enough. But in a world where it's a digital currency, they can just deactivate your currency. It's like instantly demonetized. And, you've seen this happen where they demonetize the larger bill denominations in various currencies. And that's one way to just get more control of the population, because spending privacy is, I believe, a civil right. And that's a scary thing when you don't have spending privacy.
I think eventually you're going to see, I wouldn't be owning $100 bills because I think they're going to go against them.
Mm-hmm. There used to be a $1,000 bill and a $500 bill, Yeah.
Yeah. And so the $100 bill's next.
Yep.
So,
and that's when those bills were worth a lot more money than they are today. So, a lot more.
So, I mean,
inflation adjusted.
Yeah, they're going to get rid of cash. They're going to go to negative interest rates, and eventually they're going to go to devaluation. We're in the end game right now.
Mm-hmm.
And, the best, I'd recommend, if you have a chance, go to our website and read my article, The End of Money, because I show the total debt of the United States, and I show GDP growth. And there's a wide margin between those two. So it's taken $6, $7, $8 of debt to get $1 of GDP. And you've got the Fed coming in with treasuries, with mortgages, now with corporate debt, now with municipal debt, now with junk bond debt. I mean, how much of this stuff can go on? They can't afford a deflationary asset spiral, because that's when debt becomes very toxic.
So the thing is, we've never been here before, and nobody knows the answer to that question. It's like the Malthusians, that still exist today, who say that, the earth is overpopulated. But the problem is they have no reference point because we've never been here before. We don't know if 7 billion people is too many people. Maybe the earth can sustain 20 billion or 40 billion people. How do we know how much debt a country can sustain, especially a country with the largest military the world has ever known to force its reserve currency upon the rest of the world? We just don't know, do we? I mean, it's the numbers are crazy, and your chart is crazy. Yeah, that divergence between GDP growth and currency growth, it's absolutely staggering. But we don't have a comparison, do we, Jim?
No, we don't have a comparison. The only comparison we can make is with Japan.
Yeah. I was just going to say that. 229% of GDP, right? Or something like that.
Yeah, 230%. Yeah. We're not even close to that.
Yeah.
So, we have much further to go.
Yeah.
But that's where we're going to start moving. The transition is going to be when we move from this deflationary cycle we're in now more towards the inflationary cycle, because they're destroying, by their policies, supply. You're putting all these businesses, small businesses, out of business. So that's only going to leave the big guys that are going to be left. So you're going to have limited supply. At the same time, you're going to be pushing money through the system, which is going to create demand. And one of the things that eventually they're going to have to do is, I think we're going towards 0% interest rates. They are going to drive this yield curve. And once again, if you can, go to the Wall Street Journal if you subscribe, and maybe we'll just put this graph in the next article, but I can show you the yield curve of where it's gone in the last year, where you've got 30-year treasuries falling from 3% all the way down to 1%. And then once they get through that, then we're going to go to negative interest rates. And when we get to negative interest rates, then you're going to have problems with cash. And that, I think, is...
Why do negative interest rates cause a problem with cash?
Well, because if you have money at the bank, they're going to start charging you.
Right. Well, but that's just like oil right now, right? You got to pay to store it. And if you have extra furniture, you've got to pay to store it in a self-storage unit, right? So I want to draw that comparison. Maybe, I know we totally think it's weird. I mean, I think it's weird, but I'm just playing devil's advocate here. Maybe you should have to pay to store your money. I mean, it's a weird idea. I get it, because the idea is that money always has an opportunity cost. And if you're not using it and you store it somewhere, someone should pay you to effectively rent it from you so they can use it. That's an interest rate on your savings account, for example. But, the negative interest rate paradigm flips that on its head.
Well, it's not just that, but it also distorts lending. So you're going to end up doing what Europe had to do, where the ECB had to basically give free money to banks because basically they had to pay out on their deposits where it was charging and people were just pulling money. So the Fed creates money, gives it to the banks. Hey, we're not going to charge you for this. We're going to give it to you free. And if you use it to make a loan and your cost of funding is zero, then you can still make the bank semi-function, but it's distorting the whole lending process, and it's also distorting in terms of how you value. For example, if I'm an investor and I'm Warren Buffett and I'm looking at buying a company, so Warren Buffett is a cash flow guy. Mm-hmm. So he's going to look at what is this company going to produce in terms of cash flow, and I'm going to discount that. Well, what happens if what you discounted is at zero? It distorts all those cash flow calculations in terms of what a company is actually worth.
Yeah, it's just a different paradigm. I don't know. It's very weird. I don't think it will actually work. Who knows? I mean, we're just in such uncharted territory. And just to finish off on maybe one more concept, we talked about Japan. So when the debt to GDP ratio gets absolutely out of whack like Japan, I think ours is around 100% or something like that, right? I can't remember. But Japan's is like 200.
Over 100, but pretty close.
A little over 100. And Japan's at 230%. So they're the highest ratio of any developed country for sure, by a long shot. So what happens? What does that mean to them? Well, Japan has had the loss going into 3 decades, I guess. They have this sort of like anemic economy, but they also have demographic problems and, they just don't have any immigration. And so there are other factors, right? What happens? I mean, what's the result of our debt to GDP getting way out of whack like that? What will happen in the U.S., in a country that has the reserve currency, very different from Japan, in a country that's actually growing in population, different from Japan, which is shrinking?
I think in the end, we are going to have some kind of gold-backed currency or some kind of linkage. In other words, when everybody devalues the currency, including the U.S., when we eventually do that, ECB, if it survives, which I have doubts about, or Japan or China, everybody's doing it. I could see them going to some kind of global currency that's going to have something that is going to have to give it tangible value because people won't trust it.
Mm-hmm. And you think gold's the thing, huh? Not a barbarous relic? As the saying goes.
It's been around. And let's put it this way, take a look at what central banks, if it was a barbarous relic, you wouldn't see central banks owning it.
Well, fair enough. Maybe they're just hedging though, right? Who knows?
Maybe they're just hedging what they're printing.
Yeah, hedging their own printing press. Good stuff. Well, Jim, thanks so much for joining us again. It's always a pleasure to have you on. And please do give out your website. I know you alluded to it before, but just so people have it.
Okay, it's Financial Sense, all one word, and sense is SENSE, like common sense, financialsense.com. And Jason, once again, thanks for having me back.
It's always great to talk to you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.